Hello everyone. We are group two. I'm Xinyue.
And my name is Huang Tan.
So the company we are gonna talking about is Nike. So just a little bit introductions here. So Nike Inc. is an American manufacturer corporation that is engaged in the design, development, manufacture, and worldwide market and sales of footwear equipment and service. It is the world's largest supplier of athletic shoes and a major manufacturer of sports equipment, with revenue in excess of $37.4 billion around 2020. So their own brand is valued exceeding around $32 billion, which makes it the most valuable brand among the business world. So the company was founded on January 25, 1964, as Blue Ribbon Sports, and officially become Nike Inc. on May 30, 1971. So they also have some own brands such as Air Jordans, some famous brand here. So Nike was made a member of Dow Jones Industrial Average in 2013 when they replaced Aluka. So this pictures is from their 2022 10K report. So which shows that they have the 41% revenue is from the North America, and the 28% is from EMA, and the other major two parts are from the China and APLA. So almost 60% of Nike's products are their wholesales, and around 40% are their direct sales. So the majority or the most popular sellers are things for sale is their footwears, and then is their prevos with the equipment here.
Okay, so here comes a summary of our model after we done our projections and after we done our valuation. We use two different methods. One is discounted cash flow, and then another one is we look at PE ratio of the other comparable firms such as VFCs and also PVH as well. So for this, just to highlight a little bit, current stock price as of today is $109.42 per share, and our equity value in the price based on the enterprise value based on our projection is ranging from 164 billion to 197 billion. And then if we look at our discounted cash flow valuation, especially on the base case scenario, the upside is somewhat similar to the current stock price. So reflecting on the at least a correction of our model as well. And then again, looking at PE ratio, it's not always too far off from the discounted cash flow as well. So there's also some assumptions and input that we have to make for this model to work. So again, for the general assumption is that our first year projection forecasted for this model is started in 2023. And then there's also the growth rate assumption that if you look at our model, we kind of looking at a best case, we price it at around 2% higher than the base case. And for worst case, we kind of price it around 2.5 to 3% around the base case scenario as well. And then for cost, it's a bit interesting for Nike because they don't do their own manufacturing. They do have contract with the factories to produce them the good and the finished product. And they won't receive or they won't accept any product that are not compliant with their standard. So essentially, their main cost is the cost of goods sold because they buy the product, the finished product from the supplier, and then the other major cost is the SG&A related to selling administrative of their business. And then for the interest rate, again, we got it from 10K report. And then for that covenant, also we also make the assumption about that part too. On the equity part, again, the stock price as of today, and the average stock price is around $133.54. The common share payout dividend, as we calculated, is 31%. And then for the operation, again, it's mainly based on assumption that the store does not close at all. So it's operating at 365 days per year. And for the tax rate, the company paid a corporate tax rate of 21% based on their 10K. And then the valuation will come down to the valuation method where we do the beta calculation, and then we found the cost of equity of 9.6% with the WACC of 8%. And then we projected that the company growth at a 3% growth rate as well, even though the company is a cash cow. It's also a certain, a lot of factor coming into play, a lot of competition coming into play. So 3% is a very conservative growth projection. And then come down to depreciation, we again, based on the information given in the 10K, use the straight line, as they also use the straight line as well. The year remaining to depreciate the asset is 20 years, and the year to depreciate the new asset is around the 25 years as well. And then when we look at the CapEx, capital expenditure, most of the capital expenditure is spent on the strategic capital expenditure rather than the maintenance, because essentially they are growing based on the number of sales or numbers of stores that they have. So that's why we project that the company use a lot of CapEx to build a new store, and then certain of the CapEx to maintain the store as well. And then there's like no adjustment to the earning at all. Working capital day, again, based on the calculation that we have done, using the account receivable of around 36 days. Inventory turnover is around 120 days, and then account payable is around 48 days. Again, change to debt and equity. We look at the senior debt issuance or payment on an annual basis around 500 million, and then common stock, because Nike usually, when we look at the history of it, is they usually buy back the share from the shareholder. So we also expected that it will also happen as well. So that's kind of our assumption and input as well. So coming down to the scenario analysis, what we look at, one is the economic scenario and the other one is the sales scenario. For the economic scenario, we only use the cost inflation, because essentially they are buying their product from the wholesale from the factory. That's why we expect that to grow at an inflationary cost. And then for sales scenario, we look at the four major segments that make up of the revenue. One is the footwear, the apparel, the equipment, and then there's also other other segment that generate revenue as well. So for footwear, we kind of set our projection at a base rate of 6%, which is higher than other category, as you may know, because footwear actually made up of 66% of the Nike revenue. So that's why we project it to be a bit higher than the other category. Where other category we projected to be growing at for base case sales growth of 4%. And then for next one, for the revenue and cost schedule, again, it's pretty simple. For the revenue schedule, as we see for the 2023, we actually use the years of 2022 to do the projection plus the growth rate in that category to get the number for the 2023 up until terminal value. And then for the cost structure, again, very straightforward. We project to be cost of goods sold to be growing at the inflationary cost as well. And then for the depreciation schedule, we again expected that depreciate asset using the CapEx that we have, and then the year remaining on the asset of 20 years and 25 years to depreciate the new asset that give us the depreciation schedule.
Okay, for the income tax schedules here, we firstly got the tax rate from their 10K report, which is 21%. So in this way, we can find out their earning before tax from the income statement and getting their depreciations by linking above. So finally, we get the earning before the NOL. So here's interesting. They don't have the operation loss. So therefore, there's no need to calculate the NOLs here. So it's pretty easy that we can get the EBTs by using the earning after the use of the existing NOL minus the newly NOL added here. So then we can calculate the tax. So by just time the tax rate here, we got the total income tax, and by calculating, we finally got their tax-based earning at the bottom lines here. So for the working capital schedules, again, the income statements, the income statement items are just linked from above, and the days are just linked from the assumptions page. So therefore, we can easily calculate the accounting balance and then get the net working capitals here. And by subtract, we can find out the change in working capital. And next is for the debt and equity here. So we actually created two sheets here, which is the debt and interest schedules and the shareholders' equity. So the debt and interest schedules, we can first linked from the cash flow statement to get the cash, and by sum them up and times the interest rate, which is from the assumptions page, we can get their annual interest income. So for the revolver, we can get their operation cash flows from the cash flow statement above, and by finding the common shares insurance from the assumptions here. So by calculating, we can find the free cash flow after the mandatory debt repayment and dividends. So as going to here, we can find their senior secret term debt by calculating their outstanding and additional repayments since, so times their interest rate. Therefore, we can get their net interest expense for the debt and interest schedules. So for the shareholders' equity schedules, we can find the common shares just above, and getting their net incomes from income statements, and therefore calculating the final dividends. And the return earning is also linked from the income statement. And by calculating, we will get their ending amount outstandings. So for the shares outstanding, it's also linked above. And by calculating, we will get their average fully duty shares. So I think that is all for the models part. So here is the valuation sheet. For we calculate the DCF here, and by calculating the WACC, which is the vertical lines here, we calculated four different versions, which the WACC is increased 5%, 5%. And the horizontal line is the growth rate, which is also increased by 0.5% per different versions. And by using the WACC and growth rate here, we can find out their equity value per share for these four different kinds. So the next slide is It's just a different version for the result we calculated above. So that's all for our presentations.